What if I told you the housing crash didn't start tomorrow? It didn't start next year. It has already started. While everyone is waiting for lower interest rates, waiting for headlines, waiting for permission to believe it, prices are quietly falling, inventory is piling up, and buyers are disappearing. No panic. No chaos. Just math doing what math always does. Most people think housing crashes happen overnight. They don't. They happen slowly, then suddenly. And here's the real question you should be asking. Not will prices fall, but can we calculate when they stop falling? Because if the bottom isn't a guess, if it follows a repeatable cycle, if history, prices, and income are already pointing to a specific moment in time, then waiting blindly could be the most expensive decision you make. Today, I'm not here to sell fear. I'm here to show you why the housing market is already unwinding and how the smartest buyers are using cycles, not emotions, to prepare for what comes next. So before you listen to another headline, before you wait for rates to save you, stay with me. Because by the end of this video, you'll see the housing market very differently. Subscribe and let's break the illusion with data, not hope. Let's strip away the opinions and look at what the data is actually saying. Because when you do, one thing becomes very clear. The housing market didn't just start cooling, it's already deep into the downturn. Across the US, home prices peaked in the middle of 2022. Since then, they've been sliding lower, market by market. In more than 20 major metro areas, prices today are already below where they were a year ago. That alone should get your attention. But the bigger signal is inventory. For over 20 consecutive months, the number of homes for sale has been rising year over year. That almost never happens in a healthy housing market. And it's now back to levels we haven't seen since before the COVID housing frenzy, right before prices exploded upward. At the same time, home sales have collapsed. Not slowed, collapsed. Fewer homes are being sold today than even during the 2008 financial crisis. Think about what that means. When buyers disappear, homes sit longer. When homes sit longer, sellers cut prices. And when enough sellers cut prices, the market turns, quietly but decisively. This is why the idea that housing can't crash misses the point. Crashes don't need dramatic headlines. They don't need mass foreclosures on day one. They start when supply rises faster than demand, and that's exactly what's happening now. In some states, the declines are already impossible to ignore. Places that surged the most during the pandemic are now leading the drop. Double-digit price declines, tens of thousands of dollars erased from peak values. This isn't fear. This is the cycle playing out. And the most dangerous thing you can do right now, I assume it hasn't started yet. To understand where housing is going next, we need to zoom out, way out, because the housing market doesn't move randomly. It never has. It moves in cycles, long, predictable cycles that repeat over and over again, even when people swear this time is different. More than 200 years of data show the same pattern playing out again and again, an 18-year real estate cycle. Here's how it works. First, you get about 7 years of steady growth. Prices rise slowly. Confidence builds. Lending expands. Everything feels normal. Then comes the next phase. Another 7 years, but very different. This is where prices accelerate. Speculation increases. People stop asking, can I afford this? And start asking, what if I miss out? That's the boom, the mania. And finally, the cycle ends the same way every single time, with a 4-year correction. Prices fall. Activity dries up. Excess gets flushed out of the system. This cycle accurately mapped the housing crashes of the early 1980s, the late 1980s, and of course the 2008 financial crisis. And not approximately, remarkably precisely. Now here's why this matters today. US home prices peaked around the middle of 2022. When you place that peak into the 18-year framework, it tells us something critical. We are no longer in the boom phase. We're already past it. We're deep into the correction phase. In fact, by the calendar of this cycle, we are roughly year 14 out of 18. That alone strongly suggests lower prices ahead. But here's the twist, and this is important. Something is happening in this cycle that did not happen in the previous 12 cycles. Policy responses have been faster. Debt levels are higher. Rates moved more aggressively in both directions. That means we can't rely on time alone. The cycle tells us where we are, but not exactly when the bottom hits. So if time isn't enough, what is? That's where price behavior comes in. Because right now, prices are sending a signal almost no one is paying attention to. And historically, it only appears right before the bottom. Let's look at that next. Now, this is where most people lose the plot. They look at falling prices and assume the worst is already over. But markets don't move in straight lines, especially on the way down. When you study housing crashes going back decades, one pattern shows up again and again right before the bottom. It's subtle. It doesn't make headlines, but it's incredibly reliable. It's called the triple peak pattern. Here's what that means in plain English. After prices hit a major peak, they don't just fall once and call it a day. Instead, they try to recover not once, not twice, but 3 separate times. Each rebound looks convincing. Each one gives people hope. And each one fails at a lower high than the last. That's exactly what we've seen since 2022. Prices peaked, pulled back, then rose again in 2023. They pulled back again, then tried once more in 2024. And each time buyers were weaker, volume was lower, and affordability was worse. This isn't random behavior. It's the market testing demand and finding none. Historically, this pattern showed up right before the bottom in the early 1980s, and again after the 2008 crash. In both cases, the final breakdown came after most people believed prices had already fallen enough. And here's the key insight almost no one talks about. Even after the recent declines, home prices are still well above their long-term trend. Over the past decade, normal price appreciation averaged about 2.5 to 3% per year. But during the pandemic boom, prices surged far beyond that baseline. When you compare where prices should be, based on historical growth, versus where they are today, the math is uncomfortable. There's still roughly another 8 to 10% of downside just to return to trend. That's not a crash prediction. That's a reversion. And reversion doesn't care about optimism, headlines, or hope. It only cares about gravity. So if time tells us where we are in the cycle, and price tells us we're not done yet, then the final piece of the puzzle becomes obvious. The real question isn't how low prices can go. It's how low they must go to match what people can actually afford. That brings us to the most important factor of all. This is where most housing conversations go completely wrong. Everyone is obsessed with interest rates. They wait for the Fed. They wait for mortgage rates to fall. They wait for relief to come from the outside. But interest rates don't determine the bottom of the housing market. Income does. Here's why. You can lower rates all you want, but if people can't afford the monthly payment relative to their paycheck, demand simply doesn't come back. And history shows there's one metric that consistently marks the true bottom of every housing cycle. It's called the price-to-income ratio. In a healthy housing market, homes typically cost about 3 to 3.5 times annual household income. That's the level where buyers can sustainably afford payments without stretching, speculation, or risky debt. Now compare that to today. The average American household earns roughly $80,000 a year. The average home still costs over $400,000. That's about 5 times income, far above what's historically affordable. And this gap explains everything. It explains why buyers disappeared. It explains why homes sit longer. It explains why price cuts are spreading quietly across the country. During the last housing crash, prices didn't bottom when fear peaked. They bottomed when affordability returned. In 2009, the price-to-income ratio fell back toward 3.7 times, and that is when the market finally stabilized. Today, that ratio has started to fall again. Slowly, relentlessly. From nearly 6 times income down toward 5. Progress, but nowhere near finished. And here's the uncomfortable truth. Either income must surge dramatically, or prices must fall further. Historically, it's almost always prices. So if time tells us where we are, and prices tell us there's still a downside, then income tells us something even more important. The market hasn't hit bottom yet because affordability hasn't returned. which means the final step is putting all three together and calculating not just if the bottom comes, but when. Now let's slow this down, because this is where the math actually gives us a timeline. The formula itself is simple. Step 1, start from today. In the original analysis, the reference point is late 2025. Not the peak in 2022, but where we are right now in the cycle. Step 2, calculate how much downside is still left. Based on long-term price trends and the triple peak pattern, national home prices still need to fall roughly 8 to 10%, or about $36,000 to $37,000, just to return to normal appreciation levels. That's the remaining adjustment, what hasn't happened yet. Step 3, look at the current rate of decline. Right now, prices are falling at an accelerated pace, roughly $2,000 to $2,100 per month. Not collapsing, not stabilizing, just steadily grinding lower. Now comes the key step. You divide the remaining price drop by the monthly rate of decline, $36,000 to $37,000, divided by $2,000 to $2,100 per month. That gives you a range, not a single number, roughly 12 to 16 months. And that's the critical insight. We're no longer talking about years. We're talking about roughly 1 year to a year and a half from today. So what does that mean in real time? As we move through late 2026, the market appears to enter the final phase of the correction. Inventory pressure eases. Price cuts slow. Affordability begins to stabilize. And when you extend that window just slightly forward, early 2027, most likely around February. Not because February is magical, but because that's where cycle timing, price normalization, and income affordability all tend to converge. That's how real housing bottoms form. Quietly. Uncomfortably. Before confidence comes back. And if you understand this window, you don't need to guess the bottom. You're already ahead of it. So let's bring this all together. Housing markets don't bottom when the news turns positive. They bottom when pressure quietly disappears, when time has done its work, when prices have corrected back toward reality, and when incomes can finally support the cost of owning a home again. Right now, we are in that transition phase. Not the top, not the bottom, but the part of the cycle where understanding matters more than speed. If you're a buyer, this isn't about rushing in, and it's definitely not about waiting for perfect conditions. It's about preparation, knowing your numbers, watching inventory, not headlines, and understanding that when confidence finally returns to the market, prices usually move first. If you're already a homeowner, this cycle isn't a verdict. It's a reminder. Housing moves in long waves. Short-term price moves don't define long-term value unless you're forced to act at the wrong moment. And that's the key word here, forced. Cycles punish people who have no flexibility. They reward people who understand where they are in time. Now, I want to hear from you. Do you think the housing market has already hit bottom, or do you believe there's more downside ahead? Are you waiting to buy, or are you watching from the sidelines for now? Then drop your thoughts in the comments. I read them all. And one important note before we close, nothing in this video is financial or investment advice. This is about education, perspective, and understanding risk, not predictions carved in stone. If this breakdown helped you see the housing market more clearly, subscribe to the channel. Here, we don't chase headlines. We track cycles. We follow data. And we prepare before the crowd. I'll see you in the next one.